So think about this for a second. What actually happens to a massive multi-billion-dollar software company when the main user of their product isn't even a human being anymore?
Right, when it's just a machine.
Exactly. I mean, the entire Silicon Valley enterprise software model for the last, 20 years, it's been built on one very specific, very lucrative metric, the per-seat license.
The holy grail of software sales.
Yeah. You hire 1,000 customer service reps, you buy 1,000 software licenses. Simple. But right now, artificial intelligence is stepping in. It's handling the routine queries, the password resets, the account balances.
And so the human headcount is shrinking.
Shrinking fast.
Right.
And suddenly that rigid, per-seat pricing model is facing a complete existential crisis.
It really is. I mean, it's the single biggest architectural and financial shift we've seen in enterprise tech probably since the migration from on-premise servers to the cloud.
Wow, yeah.
And a lot of these legacy companies are just staring at this transition, completely paralyzed. They're terrified of cannibalizing their own revenue streams.
But not all of them. Welcome to the deep dive. Our mission here is really simple. We take a massive stack of sources, earnings transcripts, financial statements, analyst notes, and we extract the real story. We want to give you a shortcut to being fundamentally well-informed.
Which is crucial right now.
Totally. And today, we are pointing our lens directly at a company that is actively tearing down its own legacy business model to survive this exact AI revolution. We're breaking down the Q4 2026 earnings call for 8x8. That's ticker symbol EGHT.
Yeah, and 8x8 is, they're the perfect case study for this moment in time.
They really are.
Historically, they've been a traditional unified communications and contact center provider. They built the digital plumbing, the enterprise voice lines, the secure video portals, the customer chat systems.
Right.
It was a solid business, but a highly commoditized one. But what makes their current financial data so fascinating is that they aren't just surviving a brutal macroeconomic environment. They're aggressively repositioning their core financial mechanics around AI.
Which means we are going to get highly analytical today. We're skipping the superficial Wall Street talking points. We're going to look at the top-line stabilization. We'll translate the incredibly important difference between GAAP and non-GAAP profitability.
Well, that's a big one.
Huge. We'll dissect their massive debt paydown strategy and deeply explore the actual mechanics of what they call usage-based revenue. And finally, we'll leave you with a clear, actionable bottom line on what this means for investors.
Sounds like a plan.
So let's start with the baseline reality check. How is the underlying business actually performing right now? Let's look at the revenue.
Yeah, so the initial read on the Q4 revenue shows a business that has really found a solid concrete floor.
Okay.
Q4 total revenue came in at $185.2 million, which represents a 4.6% growth year over year. And if we isolate just the service revenue...
It is the recurring part, right?
Exactly, the recurring high-value engine of the business. That hit $180.2 million, up 5% year over year.
Now, if you are, say, heavily indexed in those hyper-growth SaaS companies...
The darlings of the tech world.
Right. The ones growing at 40 or 50%, a 5% growth rate might seem like a rounding error. I mean, it sounds tiny.
It does.
But in the context of 8x8 and the unified communications sector, 5% is actually a massive signal.
Context is absolutely everything here because... a few years ago, this sector was an absolute bloodbath of price compression.
Oh, total race to the bottom.
Exactly. Everyone was fighting to be the cheapest provider of cloud phone systems. Competitors were just slashing prices left and right just to maintain market share.
Yeah.
So for 8x8 to deliver its fourth consecutive quarter of year-over-year revenue growth in that environment.
4 quarters in a row.
Right. It proves that their core enterprise customer base is sticky. They aren't churning out. The stabilization is very real.
Right. So the patient has been stabilized, the bleeding has stopped, but a stable top line is really only half the story. The bottom line is where the transcript gets genuinely surprising to me.
Yeah, the profitability metrics.
Yeah, they reported a fully diluted earnings per share, or EPS, of 11 cents for the quarter, and a net income of $16.6 million. But even more striking to me was their operating margin. It landed at 10.7%.
Which is huge.
Right. It completely blew past the high end of their own management guidance.
Yeah, crushing the guidance on operating margin is a very clear indicator of strict internal cost controls. They're running a tight ship. But as impressive as that 10.7% is, the CFO dropped a milestone on this call that honestly, it eclipsed everything else.
Oh, I know what you're going to say.
For the first time since 2015, so 11 years, 8x8 achieved full fiscal year GAAP profitability.
Okay, let's pause right here. We absolutely have to translate this for you listening, because the difference between GAAP and non-GAAP profitability is basically the difference between reality and like a very clever optical illusion.
That's a great way to put it.
Right. I mean, GAAP stands for Generally Accepted Accounting Principles. It's the rigid, standardized rule book enforced by the SEC.
Exactly. It forces a company to account for every single real-world cost. You know, the depreciation of assets, the amortization of acquired technology, and most importantly, stock-based compensation.
And stock-based compensation is the absolute killer in Silicon Valley. I read through so many earnings transcripts where a tech CEO will point to their non-GAAP profit and pop the champagne.
Right. They love the non-GAAP numbers.
But all non-GAAP means is that management created their own customized math. They say, hey, if you just ignore the $50 million in stock we printed out of thin air and handed to our engineers as bonuses, we are totally profitable.
Which is incredibly misleading to the retail investor.
Completely.
Because while issuing stock to employees doesn't drain the company's cash reserves in that specific quarter, it heavily dilutes the value of the shares that you, the investor, are holding. It's a very real cost.
It makes your slice of the pie smaller.
Exactly. So for 8x8 to declare full-year GAAP profitability means they're no longer relying on that customized adjusted math to look healthy. They absorbed every strict regulatory expense, they accounted for the stock they issued, paid all their operational bills, and still had more money coming in the front door than going out the back.
It's a massive psychological threshold. It transitions them from being this speculative turnaround play to a real self-sustaining financial entity. And that self-sustaining nature is vital because we have to talk about the historical anchor tied to this company's ankle.
The debt.
The debt.
The balance sheet has definitely been the focal point of anxiety for anyone following this ticker over the last few years.
To put it in perspective, let's think about corporate debt like a parasitic drag coefficient on a vehicle.
Right.
You can upgrade the engine, you can improve your aerodynamics, but if you have a massive, heavy parachute dragging behind you, your top speed is artificially capped. Every time you accelerate, the parachute pulls you back.
Every expensive parachute.
Yeah. And for 8x8, that parachute was a staggering $548 million in total principal debt back in 2022.
And we have to remember the macroeconomic environment of 2022.
Right. The vibe shift.
Yeah. Interest rates were beginning to violently spike. The era of cheap 0% money was over. So holding $500 million in debt when interest rates are rising is an existential threat to a mid-cap tech company.
Terrifying.
A massive portion of their operating cash flow wasn't going into research and development. It wasn't going into marketing. It was just going straight to the banks to service the interest on that debt.
Just keeping the lights on. But the Q4 transcript reveals a completely different reality. They have been meticulously, ruthlessly cutting that parachute cord. They slashed their principal debt by 43% from that 2022 peak.
43% in a couple of years is aggressive.
It's incredible. Entering Q1 of 2027, the total debt load is down to $309.4 million. And they even noted an additional $14.5 million principal payment made right after the quarter closed in early April.
And the cascading effects of that principal reduction are profound. When you pay down the core principal, the interest expense mechanically drops. They noted on the call that they've cut their trailing 12-month cash interest payments exactly in half.
Half.
Yeah, they went from paying $35.6 million just in interest down to $17.3 million.
Which means roughly $18 million in pure cash is now staying inside the company walls instead of being wired to bondholders.
Exactly.
That is $18 million that drops directly to the bottom line. It boosts net income and earnings per share without the sales team having to close a single new contract. It's an incredible financial flywheel once you get it spinning in the right direction.
And this is the exact metric that value investors and institutional turnaround specialists look for. They don't need a company to invent the next iPhone. They look for a business generating consistent, positive operating cash flow.
Which for 8x8 was $14.4 million this quarter, right?
Right. And using it to relentlessly deleverage the balance sheet. Management highlighted that they have sustained over 5 years of positive operating cash flow. That consistency is the weapon they're using to destroy the debt.
Okay, so the financial foundation is fundamentally stronger. GAAP profitability is real. The debt drag coefficient is dropping, and the revenue is stable.
Yep.
But you can't just shrink your way to long-term success. Cost-cutting and debt payments are defensive maneuvers. At some point, you have to go on the offense.
You have to grow.
Right. And this is where we get to the core of the story behind the numbers. Because the mechanics of how 8x8 is generating its revenue is undergoing a radical, incredibly aggressive mutation.
The shift in their revenue composition is the most critical narrative in the entire earnings call. It is a deliberate pivot away from their historical model.
And the standout metric in the sources we analyzed is the explosion of what management calls usage-based revenue. This bucket includes their communications platform as a service,
Commonly known as CPaaS.
CPaaS, right, along with digital channels and their new AI solutions. This specific revenue stream grew by more than 70% year over year.
That's massive.
It is. It now constitutes 23% of their total service revenue. A year ago, it was only 14%. That is a violent acceleration in adoption.
And to really understand why this is so important, we need to contrast it with how enterprise software has been sold for the last 2 decades. The legacy model was the per-seat subscription.
Right, like we talked about at the top of the show.
Exactly. If a bank needed a contact center, they calculated that they had 5,000 human agents. So they went to 8x8 or a competitor and bought 5,000 licenses. And they paid a fixed, predictable fee every single month, regardless of whether those agents were on the phone for 10 hours a day or 2 hours a day.
But wait, if usage-based revenue is skyrocketing like this, that implies the fundamental per-seat model is breaking down. So why would an enterprise customer suddenly want to change how they pay for software?
Because of the AI revolution. Enterprises are actively deploying AI agents to handle Tier 1 support. And AI doesn't need a software interface. It doesn't need a seat.
It's just code talking to code.
Exactly. It just needs a direct pipeline to the data and a channel to communicate with the customer, whether that's via SMS, WhatsApp, or an automated voice protocol. So enterprises human seat licenses when machines are doing the work is, well, it's incredibly inefficient.
I like to think of this transition like a homeowner changing how they pay for utilities. The old software model was like renting a house with a flat rate water bill.
Right.
You pay $200 a month whether you take one shower or fill up an Olympic swimming pool.
And the software vendor loves this because it's guaranteed predictable revenue.
Exactly. But the new usage-based model is like installing a highly precise digital water meter. The enterprise customer only pays for the exact drops of water they consume. You know, the specific API calls, the SMS messages sent, the AI tokens processed.
And that transition to the metered model leads us directly into what the CFO spent a massive amount of time explaining on the call. The shift from seat-based subscriptions to usage-based consumption fundamentally alters the company's margin profile.
Yes, the margin paradox. I spent an hour digging through the transcript and the historical financials to map this out because at first glance, it looks like a massive red flag.
It really does.
8x8's overall gross margins dropped to 64.2%. And in the Wall Street playbook, a declining gross margin is usually an instant sell signal.
Oh, yeah. Usually means big trouble.
Right. It usually means your product is losing value, competitors are forcing you to discount, or your server costs are spiraling out of control. So why is the 8x8 executive team treating this gross margin compression like it's part of a master plan?
Well, it requires a shift in how we evaluate profitability. We have to separate the gross margin percentage from the gross profit dollars.
Walk us through the math on that, because that's a tricky distinction.
Sure. So when you sell a traditional software seat, the gross margin percentage is exceptionally high, often 80 or 90%.
Because it's practically free to duplicate.
Exactly. Once the core software platform is built, the cost to deliver one additional license to a human user is functionally zero. It's just flipping a switch on a server. However, usage-based revenue operates completely differently. There are hard, variable costs tied to every single transaction.
Right.
If a customer sends 1 million SMS messages through 8x8's CPaaS platform, 8x8 has to pay underlying telecom carrier fees to route those messages across global networks. If a customer uses 8x8's AI to process voice queries, 8x8 incurs compute costs for processing those language models.
So the cost of goods sold is naturally higher for usage-based products.
Exactly. Because the cost of goods sold is higher, the gross margin percentage on that specific bucket of revenue is lower. And as that usage-based revenue explodes,
Growing 70%
and taking up a much larger slice of the total revenue pie, it mathematically drags the blended company-wide gross margin percentage down to that 64.2% figure.
Okay, but here's where the paradox resolves itself, and it has to do with operating expenses, or OPEX. The CFO argued that while this new revenue costs more to deliver, it costs exponentially less to maintain.
Yes.
When you sell complex software seats to human beings, you need an army of highly paid salespeople to negotiate the multi-year contracts. You need a massive customer success team to onboard the users, train them, make sure they renew next year.
Hand-holding.
Lots of hand-holding. But an API doesn't need customer success training. A machine-to-machine SMS routing protocol doesn't require a dedicated account manager to take it to lunch.
Right.
Once the API is integrated into the customer's infrastructure, it just runs. The volume scales up automatically without 8x8 needing to hire additional staff.
So the management team is making a deliberate trade-off. They are perfectly willing to accept a lower gross margin percentage on the front end because the lack of overhead on the back end means they actually generate more raw gross profit dollars in total.
Precisely. And the financial results validate this strategy. They successfully offset the drop in gross margin percentage with a highly disciplined 5% year-over-year reduction in operating expenses.
They aren't spending money to support the legacy overhead.
No, they're leaning entirely into the high-volume, low-friction usage model. It's a brilliant structural pivot, and it's driven by a very specific philosophical stance from their CEO, Samuel Wilson.
Yeah, Wilson was very clear on this.
There was a moment on the earnings call that really stood out as a battle cry for this transition. He explicitly declared war on the concept of shelfware.
That was perhaps the most defining strategic moment of the transcript.
For anyone outside of enterprise tech procurement, shelfware is exactly what it sounds like. It's software that a company buys, pays for every month, and literally no one uses.
It just sits on the digital shelf.
It happens all the time. A retail company might buy 2,000 contact center licenses because they need that capacity for the frantic Black Friday and holiday rush in November and December. But for the other 10 months of the year, 800 of those licenses are just sitting there gathering dust.
Well, the company continues to pay full price for them.
Right. And the CEO noted that chief financial officers across the globe have lost their patience with this model. In a tight macroeconomic environment, CFOs are aggressively hunting down unused software licenses and cutting them. It's a massive misallocation of capital.
Wilson used a great phrase. He called it fundamental lunacy. To ask an enterprise customer today to predict exactly how many AI voice interactions or API calls they're going to need 24 months from now.
Fundamental lunacy, I love that.
It is. The technology is simply evolving too fast to make those kinds of rigid multi-year forecasts.
And by calling it fundamental lunacy, he's intentionally cannibalizing 8x8's legacy business model. They are actively walking away from the false security of shelfware revenue.
Which takes guts.
It really does. Instead of fighting their customers to lock them into rigid contracts, they're offering them the digital water meter. They're shifting to outcome-based pricing. If the customer runs a massive AI-driven marketing campaign this month and utilizes immense bandwidth, 8x8 captures that upside.
But if the customer's volume drops next month, their bill drops.
Exactly. It perfectly aligns the vendor's financial success with the actual realized value of the customer. But, to capture all that usage, 8x8 has to offer more than just basic SMS routing. They have to provide the actual tools that generate the usage.
Which brings us to the product side.
Right. And that is where we saw a flurry of AI product announcements and acquisitions deeply integrated into this earnings report.
They're building out a very specific kind of ecosystem to support this. They discussed the rollout of 8x8 Engage, which is designed to bring sophisticated contact center capabilities out of the centralized call center and directly into the hands of regular frontline knowledge workers.
Decentralizing it?
Exactly. They also highlighted AI Studio, which empowers customers to rapidly build and deploy automated AI voice and digital agents directly onto the 8x8 infrastructure.
But the underlying architecture of how they are building this AI is what really matters. Our research into the broader enterprise software landscape shows a massive philosophical war currently raging. The battle between open and closed ecosystem.
It is the defining architectural debate of the AI era.
A closed ecosystem is the walled garden approach. Think of Apple's historical model. A massive software vendor will build their own proprietary large language model, their own proprietary database structure, and their own interface.
They trap you in it.
Exactly. They go to the enterprise customer and say, if you want to use our AI, you have to rip out all your existing tools and migrate entirely into our walled garden. You use our model or you get nothing.
But the problem with the walled garden approach in 2026 is the sheer velocity of AI innovation. The landscape is moving at breakneck speed.
It's changing weekly.
Literally.
Yeah.
OpenAI releases a new model, then 2 weeks later, Anthropic releases a better one, then Google responds, then an open source model from Meta changes the game entirely.
Right.
If an enterprise locks itself into a single vendor's closed AI model, they risk being technologically obsolete in 6 months.
Exactly. And 8x8 recognizes this reality. They are taking the exact opposite approach, the open integration layer. They are not trying to convince a massive global bank that 8x8 can build a better underlying AI brain than OpenAI or Google.
That would be arrogant and foolish.
It would. Instead, 8x8 is positioning itself as the secure carrier-grade highway.
The orchestration layer.
Right, the orchestration layer. They go to the enterprise and say, bring whichever AI model you want, bring ChatGPT for your text analysis, bring a highly specialized local model for your secure voice authentication. We don't care what engine you're using.
Just use our roads.
Exactly. What we provide is the global telecom routing, the regulatory compliance, the secure data handoffs, and the API infrastructure that allows your chosen AI to seamlessly interact with your human customers over phone lines and text messages.
It's a highly pragmatic strategy, and they're accelerating this open architecture through what Wall Street calls tuck-in acquisitions.
Buying the missing pieces.
Right. Rather than spending years in R&D trying to build every single integration from scratch, they're buying specialized agile companies to plug into their highway. The transcript highlighted several of these.
Yeah, I saw those.
They acquired Synflow AI to immediately bolster their agentic AI capabilities, specifically tailored for small and medium-sized businesses. They bought Maven Labs to drastically expand their messaging automation capabilities. And they acquired CallRoute to completely smooth out their integration with Microsoft Teams.
Which is a massive ecosystem they need to play nicely with.
Absolutely essential.
And the most important metric is that enterprise buyers are actively rewarding this strategy. The earnings call was packed with specific customer win narratives that validate the open, usage-based model.
Real-world examples.
Yeah, they cited a major insurance company that was evaluating 6 different vendors. 6. They ended up replacing 2 entrenched competitors specifically to consolidate onto 8x8's platform. They mentioned a healthcare organization with over 100 locations that chose 8x8 for a complete omnichannel rollout.
Wow.
There was even a prominent bank in the Philippines that selected them over the competition entirely because of 8x8's secure authentication and fraud prevention integration features.
So the market is clearly exhibiting fatigue with fragmented, closed-point solutions. They want an orchestration layer that simplifies the complexity of deploying AI.
And 8x8 is providing that layer.
Yeah, and the 70% growth in usage-based revenue is the direct financial manifestation of that success.
Okay, so the past is stabilized, the debt is shrinking, and the technological pivot is clearly resonating with the market. But as we transition to looking forward, we have to acknowledge the reality of the stock market.
It's always about tomorrow.
Always. The market is a forward-looking mechanism. It rarely rewards you for the earnings you just posted. It prices you based on the cash flow you are going to generate tomorrow. So let's dissect management guidance and see what the executive team is actually promising for the future.
The guidance is where the narrative shifts from aggressive optimism to highly measured pragmatism.
Let me run through the short-term numbers first. For Q1 of fiscal year 2027, management expects total revenue to land between $180 million and $185 million. They are projecting an operating margin right between 8.5% and 9.5%. And they expect fully diluted EPS to be between 8 cents and 9 cents.
Those are steady, sequential numbers. It shows they expect the current stabilization to hold through the immediate next quarter without any major operational disruptions.
But the real scrutiny falls on the full year 2027 outlook. They projected full-year total revenue to be between $725 million and $747 million. EPS is guided at 33 cents to 38 cents. And the crucial operating cash flow metric is expected to remain massive, coming in between $45 million and $52 million for the year.
And that $45 to $52 million in operating cash flow is the exact fuel they need to keep the debt reduction flywheel spinning. As long as that number holds, the turnaround thesis remains perfectly intact.
Right.
However, we have to address the anomaly in the revenue guidance.
Yes, the sandbagging debate.
It was a big moment on the call.
It was. During the Q&A portion of the earnings call, an analyst from Citi pointed out a mathematical reality. If 8x8 hits the lower end of that full-year revenue guidance...
The $725 million mark.
Right. If they hit that low end, it actually implies a deceleration in their top-line growth rate compared to the momentum they just demonstrated in Q4. It begs the question, is the executive team intentionally sandbagging?
Are they lowering the bar on purpose?
Exactly. Are they artificially lowering the bar so they can easily step over it and declare victory in future quarters? Or is there a genuine structural headwind they're worried about?
Well, CEO Sam Wilson met that question head on, and his answer revealed a lot about the structural realities of their new business model. He openly acknowledged that the forecast is highly conservative. But he argued it wasn't a deceptive sandbagging tactic. It's an unavoidable consequence of moving away from shelfware.
Right, the lack of visibility.
Exactly. When 100% of your business is built on rigid 3-year per seat contracts, forecasting your revenue 12 months out is incredibly easy. You just look at the spreadsheet.
It's locked in.
Right. But 8x8 has intentionally evolved. Usage-based revenue is now 23% of the total pie. When a quarter of your business relies on API tokens, SMS routing, and AI queries that carry zero minimum commitments from the customer.
Your crystal ball shatters. Completely shatters. You literally cannot predict if a retail client is going to run an SMS promotional blitz in October that drives millions in usage revenue, or if their AI deployment will be delayed by internal compliance reviews until next spring, resulting in zero usage revenue for that quarter.
It's fundamentally unpredictable on a granular level.
So management is opting for financial prudence. They are building their guidance on the baseline recurring revenue they know with absolute certainty will materialize, rather than aggressively modeling usage spikes that are at the mercy of their customers' deployment schedules.
And the CFO, Kevin Krause, layered on an additional macroeconomic justification for that conservatism. He reminded the analysts that roughly 40% of 8x8's total revenue is generated internationally.
That's a huge chunk.
It is. And we are operating in a deeply fragile geopolitical and economic landscape right now. Inflationary pressures in Europe, fluctuating interest rates across global central banks, general geopolitical instability.
It can cause massive enterprise organizations to suddenly freeze their IT spending overnight. Exactly. By keeping the top-end revenue guidance muted, 8x8 is baking in a necessary buffer for that global unpredictability.
It's the hallmark of a mature executive team. They are clearly prioritizing predictable cash flow and the protection of their operating margins over trying to project an illusion of unstoppable hypergrowth.
Yeah.
They can tightly control their operating expenses, but they cannot control global enterprise API consumption patterns. So they're focusing strictly on what they can control.
Which brings us to the culmination of our analysis. We have synthesized the earnings transcript, we've broken down the GAAP profitability milestone, mapped the massive debt reduction, and explored the structural pivot from seat-based shelfware to the API usage metered model. Now it's time to deliver the bottom line.
The takeaway.
Right. We have to take a definitive stance based on the data. What does this mean for you, the retail investor? Are we fundamentally bullish or bearish on EGH today?
You cannot evaluate 8x8 today using the same metrics you would have used 5 years ago. Based on the financial mechanics we have unpacked, I view this as a firmly bullish signal. But with a very specific caveat. It is bullish exclusively for value investors and turnaround specialists.
I am in complete agreement. The thesis here is rooted in cash flow and deleveraging, not explosive market share capture. Which means we must clearly state the bearish counterargument.
Right. Who is this not for?
If you are an investor hunting for a hyper-growth SaaS multiplier, if you're looking for a company that's going to post 30 or 40% top-line revenue growth, and you're perfectly willing to tolerate massive cash burns and negative margins to achieve it,
This is not your stock.
this is not your stock. 8x8 has graduated from the growth at all cost era of Silicon Valley. The days of aggressively discounting software to win logos and burning millions in OpEx just to show top-line momentum are definitively over.
Yeah, this is now a mature, cash-generating, pragmatically managed business that is successfully navigating an existential transition in how software is consumed. Achieving GAAP profitability while executing that pivot is an incredibly rare feat in the cloud communications sector.
So let's make this highly actionable for you, the listener. Whether you are currently holding shares or evaluating a position, here is the single most important takeaway. Stop obsessing over the top-line revenue percentage.
Ignore the noise.
Exactly. A 4 to 5% growth rate is perfectly adequate for this specific turnaround thesis. The real story, the absolute engine of value creation for this equity right now, is the debt paydown schedule.
That is the metric that dictates everything else. In their forward guidance, management committed to making $39.5 million in principal debt payments over the course of fiscal year 2027.
$39.5 million.
That is the number you need to write down and track in every subsequent earnings release.
If they consistently hit or exceed that $39.5 million target, the financial snowball effect we discussed earlier accelerates. The interest expense continues to plummet. Every dollar saved on interest flows directly to net income.
EPS rises mechanically, independent of revenue growth.
Exactly. The overall risk profile of the balance sheet improves dramatically. And as the company becomes fundamentally less risky and more profitable, institutional investors often reward the stock with a multiple expansion.
It's a phenomenal masterclass in operational discipline. When the AI revolution threatened to render their core seat-based product obsolete, they didn't panic.
And they didn't stubbornly double down on the old way of doing things either.
No, they adapted the architecture, slashed the operating expenses to protect the margins, and ruthlessly focused on using the resulting cash to buy back their financial freedom from the bondholders.
It's exactly what you want to see a management team execute in real time. But before we wrap up, I want to pull back from 8x8 specifically and leave you with a much larger, provocative question to mull over.
Okay.
Something that impacts almost every tech stock in your portfolio. We talked about how 8x8 is actively dismantling the per-seat software model out of sheer survival necessity, embracing the usage-based future because AI is eliminating the human seats.
The transition from the buffet to the digital water meter.
Exactly. But here is the multi-trillion-dollar question. What happens to the absolute giants of the SaaS industry? The massive CRM platforms, the global productivity suites, the project management monoliths.
Huge players.
Right. Their entire multi-hundred billion-dollar valuations are built on the assumption that enterprise customers will continue to buy tens of thousands of human seat licenses indefinitely.
Which is looking less and less likely.
Exactly. As AI agents begin doing the work of junior analysts, copywriters, data entry clerks, will these massive tech giants willingly abandon their incredibly lucrative seat licenses and embrace a metered, consumption-based model? Or will they violently cling to a dying pricing structure, praying their customers don't realize that a machine doesn't need its own software license?
That tension between legacy pricing and AI automation is going to be the defining battleground for enterprise software valuations for the next decade.
It is going to be a fascinating collision to watch. And on that note, we are going to wrap up this analysis. Thank you for joining us on the deep dive. Thank you for bringing your curiosity and for trusting us to filter out the Wall Street noise and deliver the underlying signal. Keep a close eye on those debt levels. Watch how the usage-based revolution unfolds across your portfolio, and we will catch you on the next deep dive.